David Bahnsen joins us right now, the Bahnsen Group, and it's usually the big picture. What's the Fed going to do? Forget about it. Love what he does, author of many books. We're at the bottom. He actually says, hey, shut up and buy this. And I love how you go to the Bronfins. You go to one of the iconic Toronto companies. We got NVIDIA this afternoon with the PE, Paul, is 46.
No problem.
And they're going to earn their way into a PE of 31. And I got Brookfield Infrastructure Corporation of, they're here, they're there, they're Canada. The basic idea, help me, is a PE of 6.
It's very hard to measure a P in a company like that, but it's distributable cash flow as a valuation metric is extremely cheap, and all of these capex sensitive companies are very, very attractive.
So what's the word infrastructure mean? Is it just fancy marketing for a REIT? Or are they actually, do they own LaGuardia? I mean,
yeah, in this case, they own, build, and operate pipelines, data center, some clean energy plays. It's very diversified. Brookfield and then Blackstone are kind of the two leaders in the space, but this BIPC is the company that incorporates this real estate portfolio of assets. It's very cash flow generative.
It's gone nowhere for 5 years. What's the catalyst for this thing to pop?
It's not so much a pop in stock price we want as a pop in the ongoing dividend growth. So as cash flow grows, and they're distributing more of it to us. And in the meantime, we think data center is a growth catalyst. The pipeline play is obviously a growth catalyst. You have very attractive yield spreads there. So they make money by acquiring assets at the right price, building them, and then cash flowing them.
David, I know in your business you focus on dividend paying companies. Do you focus more on dividend yield or dividend growth or some combination? How's that work?
Well, it's obviously a combination in the sense that we have to have an entry yield that wets our beak, but dividend growth is the thing I've built my career around. Sometimes I feel like I built my life around it. But no, a high yield is not what we're looking for, and I can explain why. And then even a good, like aristocratic dividend growth with low yield is not what we're looking for. So it is a both and, but fundamentally we want some yield higher than S&P. I mean, our portfolio blends to a 4.1. S&P is at about a 1.1. So that's a big delta. Yep. But a bunch of 8s, 9s, and 10s is not what we're after, because essentially most of those are what are called accidental high yielders. Okay. The stock dropped 50% and the dividend is about to be cut. We don't buy those.
So in terms of dividend growth, when you speak to managements, do you say, hey, I want it in some relation to your net income or to your free cash flow? How do you measure dividend growth, and what's a good policy from your perspective?
It's both quantitative and qualitative, and I love what you say speak to management, because we do speak to management, and there are companies you can tell in about 30 seconds that they are good dividend payers reluctantly. We don't want that. There has to be a propensity for management to grow the dividend. A lot of times, founder-led companies that have a lot of family stock, those are very good shareholder-aligned organizations. When the CEO has absolutely none of his or her own money in the company and got everything from compensation, they tend to not be great dividend-aligned people.
Is a share buyback a dividend?
No, it is not.
Why?
Because a share buyback is generally offsetting a share issued. About 80% of share buybacks are merely paying the company back for new shares they issued in executive compensation, and share buybacks are told to us by way of authorization. They're not told to us by way of purchase, so we don't find out if they ever did it or not to 6 to 12 months later.
But what about the 20% where they are actually reducing shares over a
Then
decade?
that is increasing earnings per share, which is usually the metric CEO bonuses are tied to. You cannot then use that if you are an investor who has groceries to buy. You can't get cash flow.
Here endeth the book of Sweeney.
Exactly. If I put you in a room with Tim Cook at Apple, what would your conversation be like?
Well, I don't know that I would go straight to this, but I would hope at some point I would say, do you believe that at this level of free cash flow generation, the greatest in human history, that those who took a risk on your investment going forward, don't talk about the last 10 years, do you believe that you will produce a better return by sharing some of the free cash flow with investors? There is no plausible argument for that answer being no. For them to continue paying a 0.5 point yield at this sort of free cash flow is absolutely...
And Paul, the elephant in the room, and on the Bloomberg terminal, folks, is one of the most emotional numbers. 5-year dividend growth, AAPL, I would have thought it was 9 or 10%, 5.24%.
Yeah, look how far their earnings. And I've had that conversation with Tim Cook several times down at Duke, and I've gotten nowhere with him. So I'm trying to. So
and either of some of the hedge funds that have kind of gone after it. At one point, I think Icon did. I know Einhorn did. There's a few that have gone that way, and they haven't made any progress.
Talk to us about IBM. I looked at this stock just recently, and it surprised me how well it's performing. Talk to us about it from a dividend perspective here.
Well, that's how you knew the stock was going to do well, because management continued to grow the dividend. They seemed to pay up to buy Red Hat. They continued to grow the dividend. They continued to free cash flow very well. They're old businesses, the boring ones that Wall Street would put no valuation on. They're just the hardware and the consulting and those things. But then now they've become a major player in hybrid cloud. They have an AI book that's growing $1 billion to $2 billion a quarter. And in the meantime, the dividend growth has led the stock growth. So we're up about 100% from purchase, and the dividend's up about 100%.
The European companies, as a rule, particularly hydrocarbons, they pay a bigger dividend, sometimes with a lesser dividend growth. But is there opportunity there for a dividend growth strategy?
There are. Now, the problem is, like, we owned GlaxoSmithKline, for example, for a while. It was a high dividend that wasn't growing, and then they started spinning off the consumer product and pharma. Some of these companies, Vodafone ended up being a dividend cutter. We don't care where the stock is domiciled, right? We're very happy to buy a company that's listed on a different exchange, but there is a cultural propensity. It's true in Japan as well. They haven't normalized dividends the way that we have here in the States. Investors want the regularity. So the McDonald's, Procter & Gamble's, J&J's of our market long ago figured out they had to smooth the dividend growth. Europe and Asia hasn't quite done it the same way.
LVMH, 2.7% yield. It's been underperforming. But the 5-year dividend growth is 16%
Yeah, it's been a great dividend grower.
Is that a legit dividend grower?
It is, of course. So that double-digit percentage growth over a 5-year period is enough to make us very interested. The problem is it's a consumer staple company. It's hardly recession-proof, and those I said consumer staple, I meant consumer discretion. Consumer discretionary tends to be the worst dividend growers.
Right.
So taxes, proposed tax changes impact on dividends?
No, there's nothing in the tax bill changes anything whatsoever.
Okay, there you go.
I just want to point out that President Obama got reelected, and he didn't and he didn't even need to legislate. It was already going to sunset from the prior Bush Jr. legislation, and they left it in place. Dividend taxes are not going higher.
David Bahnsen, thank you so much. Really brilliant. Thank you for, particularly on Brookfield of Canada and New York as well. Mr. Bahnsen, the Bahnsen Group. Thank you so much.